the fourth PPM meeting. Today we're very lucky to have a guest speaker, Dr. Doellman. He teaches my stocks class. He's an associate professor of finance and the head of the Applied Portfolio Management program. So he's going to be introducing a couple topics today, which I'm very excited to hear.
I overheard John refer to this as a lecture earlier. It's not a lecture, okay? It's just a discussion. So please feel free to interrupt, ask questions, speak whatever's on your mind. So I have a few things that I want to talk about today. I was asked to talk a little bit about the course that I teach, Applied Portfolio Management. You can kind of think of this as an honors class in the finance department. I like to think of it as experiential learning at its finest, okay? So in this course, students are acting as real-world equity research analysts, and they're managing actual money, okay? So the course is built around a student-managed investment fund. So those are really very common across universities. However, ours started way back in 2003. And at that time, we were actually well ahead of the curve in terms of offering our students an opportunity like this to manage real money. So today, the investment portfolio that students manage is worth almost $3 million. And it is a separate account of the overall endowment. So it is technically endowment assets. Anybody have any idea what SLU's endowment is roughly valued at these days?
Complete guess, 2-3 billion?
1.8 billion, all right, as of June 30th of this year. So, and that is up from about 1.1 billion, I believe, around the time of the pandemic. So things are looking up, but then obviously SLU also had the bicentennial fundraiser event a couple of years ago that helped as well. But anyway, so this is technically part of the endowment. The portfolio consists of roughly 20 individual stocks. Okay, so the fund is not investing in, or the portfolio is not investing in funds. It's investing in individual stocks, individual financial securities, specifically U.S. equities, or U.S. listed equities. Okay, so this is just an example of some of the companies currently held by the portfolio. Okay, and again, kind of a pseudo honors class. Students have to apply to get into the course. Okay, so this is the 2023 class. It's offered in the fall, so I just don't have a group picture of my 2024 class yet. But the 2024 class is hard at work right now, and their first round of presentations actually start next week. So typically students apply the spring of their junior year and take the course the fall semester of their senior year. A typical class is 16 to 18 students. This semester we have 16 students. Okay, each student analyzes one stock that's currently held by the portfolio, and then they get to choose a second stock to analyze as well from the same sector. Okay. Students produce a research report for each stock, including an investment recommendation, so buy, sell, hold. Okay. Students must also present a 10-minute oral defense of the recommendation, followed by a 10-minute Q&A. Okay. So they are producing actual real-world type equity research reports with their recommendation and defense of that recommendation to the class. Okay. I want to take a little segue here to talk a little bit about the CFA Institute Global Research Challenge. That'll make sense here in a second. But the CFA Institute puts on a Global Research Challenge every year. Undergraduate and graduate students can compete in the challenge, and as the name suggests, universities from around the world compete in it annually. Why is this significant? Well, the CFA Institute is the flagship industry certification for financial analysis. Okay, so it's considered the highest industry credential that you can earn in investment research and portfolio management. Okay, this global research challenge takes place every year. Okay, again, it's put on by the CFA Institute, which is the leading industry body on investment research and portfolio management. Okay, in 2023, over 6,200 students across the world participated. 119 local challenges, over 1,000 universities were represented. Okay, so what I've done starting in 2020 is the report guidelines. Pretty much everything required of my students in this class follows the guidelines of the CFA Research Challenge. Okay, so again, if this industry body is suggesting that, you know, these report guidelines or this particular report that they require of students is, you know, what they would expect from an industry professional, why wouldn't we adopt those same guidelines? So again, students doing real world work, producing real world deliverables in the classroom. Okay, in 2020, I also implemented an industry mentoring program. So each semester, each student is paired one-to-one with an industry professional, most of whom have their CFA designation, and all of whom are either currently working in equity research or have extensive experience in equity research. Okay, many of the mentors are right here in St. Louis, but we also have mentors on the East Coast as well. Here are some of the companies represented. Okay. This semester we actually have 3 industry mentors who are alumni not only of St. Louis University, but alumni of the course itself. So, as I said before, having a student managed investment fund is not unique to St. Louis University. Okay? So when I took over the course in 2017, one of my objectives was to try to differentiate what we offer students from the other universities out there. And the changes that I made to the course curriculum and with the industry mentorship program has had very real impact on our students. Okay? We have a team of SLU APM students has participated in the CFA Research Challenge for, I believe, close to 20 years, but I know for over 15 years. Okay? We had never won the local challenge, the St. Louis local challenge. A big reason for that, it's not that Washington University wins every year, but a big reason for that is, again, undergraduate and graduate students can compete. Okay? And we draw from some pretty stiff competition in the region. University of Missouri, University of Illinois, Urbana-Champaign, obviously Washington University right in our backyard, Southern Illinois University, Carbondale, and WashU almost always enters 2 teams, an undergraduate team and a graduate team. Well, in 2022, for the first time ever, a SLU team won the local challenge. And not only did they win the local challenge, but they actually advanced all the way to where they were one of only 16 teams remaining in the competition in all of North America, so South Central and North America. And that same year, our second SLU team took second place. So we took first and second place. Both teams made up of only undergraduate APM students. In 2023, stiff competition, but we took home second place. And then earlier this year, a SLU team for the second time in 3 years won the local challenge. Again, teams from Washington University, University of Illinois, among others, were in the competition. Okay? So it's a really very unique experience that is offered right here at the Chaffetz School. And it's not just finance that is really investing a lot in our students and the experiences we can provide. It's all the programs within the Chaffetz School. So these sorts of experiences for students are what we're really trying to push in the shaded school. And there's a great opportunity for those of you who are interested in finance. Okay. Any questions or anything on APM? Yeah.
Did you say how you were selected for this? It's from the APM program, right?
Yeah, so in the spring semester, the finance department puts out a call for applications. Okay, so there is an application process. And then once all the applications come in, as a department, the finance department meets and we go through the applications and we work it down to the top 16, 18 students. So it's not just me making the decision. I always like to remind students of that. It's a collective effort by the department. Saj?
What criteria do you look for when making those decisions?
Yeah, so the biggest criteria we look for is ability and diligence. So being an active participant in your courses is a big positive. When we get together as a group to go through applications, if you have made a positive impact in the classroom with a finance faculty, that carries a ton of weight, right? So we have those sorts of conversations. So we want to make sure that we're admitting people who are not just capable. So GPA is certainly not the main criteria we go off of, but obviously ability is important. I would say that we place the highest weight on just motivation and diligence on the part of the student. Can a student handle the rigor of a course like this? Because that's one thing I would also say is while this class, in my opinion, provides students with one of the most unique experiences you're going to get in the classroom as an undergraduate student, it also creates probably the greatest challenge that you're going to face in the undergraduate program. So that's really what we're looking for. So. Any other questions? Yeah.
Is this done with SLU's actual money, or is this like a paper trading?
No, like I said, it's actual endowment funds. So it's actual $3 million. So at the end of the semester, we spend the final exam period and the period before that. So we spend about 3 hours as a group going through all the recommendations and ultimately deciding which holdings are going to be sold and which new holdings are going to be bought. We determine what the allocation will be to the different stocks. And when all that's decided, I'm actually going in to our brokerage account with BNY Mellon and making all the trades and transactions. Yeah.
Yeah. What percentage would you say is the students making the final decision? I mean, I don't know how much your input carries.
100% student driven. I do not get involved in, no, you cannot do that or whatever. There's no penny stock investing, but as long as it's a U.S. listed company, we have to have exposure to each sector, so we're not going to just, divest out of entire, sectors. So, we want to make sure that we're holding roughly about 20 names, but there's very, very little limitation on what those names would be. But I never get involved in terms of that's a bad decision or I don't think that's a good idea or it's purely student driven. Yeah.
So are we restarting the portfolio every year, or are we building off of?
No, yeah, we're building off the existing portfolio. So, there might be a time where we have students managing the portfolio in the fall and the spring, but historically it's only been in the fall. So when we make our investment decisions this semester, those stocks are going to be held until next fall. So the students really are kind of taking your traditional 1-year price target type of consideration. Now, of course, you know, fundamental investing is important. At the end of the day, we want to own names that you would be happy owning for a long time, but you do kind of have that 1-year holding horizon in mind, knowing that it'll be about a year before those investments are reconsidered. Yeah.
And what's your weight criteria?
The weight criteria? Again, I mean, we have to have exposure to each sector. We have to have 18 to 22 names. All I do at the end of the semester is pull up the sector weights in the S&P 500 so that the students have an idea of how much, you know, cap weighted exposure each sector has. But they are free to underweight, overweight sectors. We don't have a stipulation where it's like you can't have more than X% in one stock. But we do have to have, you know, we still have to have that diversification across the U.S. Market. Yeah.
What have typical returns been across the year for the class?
Yeah, that's a good question. So because we don't really have any restrictions per se, other than US listed, we just use the Vanguard Total Market Index as the benchmark. And historically, on average, we've underperformed the market by about 100 basis points. So not terrible, but definite underperformance, which I'm going to talk about here in a little bit. It might be more than that, actually. It might be more than like 150 basis points.
Do you guys leverage short selling?
No, yeah. No margin, no leverage, no short selling, just long equity positions. Yeah.
Does the portfolio ever get like an influx of cash from the school, or is it always the same level like as it was?
That's a sensitive topic for me, actually. This is being recorded, so I better be careful. So the fund started back in 2003 with about $500,000, but I forget when. Money was actually taken out of the fund to help with the data analytics lab, which is where the course is housed and where all the Bloomberg terminals are and stuff. So Edward Jones made a large donation. I don't know if that paid. I want to say that Edward Jones's donation might be helping to pay for the terminals, and then the money taken from the APM fund helped with the room. But some, you know, money was extracted at some point, and it's worth like $3 million now. I have tried to advocate for a management fee, like basically the students should get to charge a management fee, and then that money would be used for you know, various things that would benefit the students, like, you know, campus visit to, you know, a local firm, or, you know, a visit to Chicago, or you know, for students who secure high-profile internships, but like in large cities away from St. Louis, maybe some scholarship to help with living expenses, those sorts of things. So myself and Dr. Bansel, who's the chair of the finance department, we're actually in the process of trying to make a larger scale honors program funded by, you know, alumni donations, so that we can provide some of those opportunities to students. So right now, you know, a lot of what we're doing really mostly benefits the students that take APM, and we want to kind of try to expand, you know, the impact that we can have on our students. So. Okay, I better move along unless there's any pressing questions. Okay, so to get into a little bit on me, personal and research interests. Okay, much of my research is focused on retirement investing and behavioral finance. Okay, a common thread of my research has been to be an advocate for investors and to explore ways the financial industry could do better for individuals and families. Some of my research has been featured in big national publications, which is fine and dandy, but the idea here is to try to make real impact. So motivated by my research and a desire to help others navigate their financial futures, I started a wealth management firm along with a few other, two friends in 2020. It's called Elemental Wealth Group. And again, it was founded with two of my good friends who share a similar passion for trying to make an impact in the industry. One of my partners has over 15 years experience in wealth management and financial planning. The other partner is a close friend of mine that we earned our doctorates together from the University of Florida. And a lot of that research that I referenced, he and I had done together. So we kind of saw it as an opportunity to take what we've learned through our research and our expertise and try to make an impact in the industry. Also motivated by this passion, when the university put a call out for Ignite seminars, which some of you may be familiar with, some of you may not be, but it's now a requirement of all students with the new core curriculum. I developed a course called Financial Education for a Happy and Healthy Life, where we not only look at some very important financial literacy topics, but also study how finance intersects with society, as a whole, and how that has not always benefited everyone, and how maybe we can use finance in the future to do better. I taught that course for 2 semesters, and because of a resource crunch in the finance department, I'm currently not able to offer that course, but I hope to in the future. Okay, but another thing that I was asked to kind of talk about was just kind of some general advice on the importance of starting to think about your financial futures as early as possible. And just some things that you might want to carry with you along your way. The sooner you can learn about these things and actually start living by them, the better off you'll be. And the sooner you get educated on these things and help educate others, the better off we'll all be. Because financial literacy in the United States is a big problem, for sure. And that's not just for the uneducated, that's for everyone, okay? I always give my sister as an example because she's family and I can pick on her. But she's a very, very accomplished attorney, does great work, extremely intelligent, but not a single person in here would want her managing your money, okay? So this is a problem for all walks of life in the United States, okay? So tips to get started and to never forget, okay? Why wait, okay? My freshman students in my Ignite seminar probably got sick and tired of the number of times I repeated this phrase throughout the semester. It's never too early to start investing for your future. And very importantly, no amount is too little, okay? Often that is what gets in the way of people starting to save early is, wow, I can't really afford to really save much more than $50 a month. What's the point? It's so little, it's not going to make a difference anyway, right? And it's just not true. No amount is too little, okay? So that's probably the most important thing, especially for people your age, is to drill that into your head, okay? It's never too early and no amount's too little. Prioritize yourself, okay? It's hard to go broke if you always pay yourself first, okay? So again, this is pretty common advice out there, but it's real and it's something that you definitely want to take seriously, okay? Another very common piece of advice out there, and for good reason, automate your savings and investment, okay? The less you have to think about it, the better, okay? So for most of our clients, Okay, so you know, most of you are probably at least somewhat familiar with like a 401k plan or generally speaking an employer retirement plan, right? Where every paycheck automatically, a small percentage of your paycheck is automatically going into your retirement account. So you never see the money, right? It just automatically goes in there. We do that with a lot of our clients for their other investment accounts, right? We have it set up to where that money is automatically coming out of their paycheck, right? So that they don't ever see it. They don't get used to living on that money. That money is automatically going into the account for themselves. So it's not just through your employer retirement account that you can set those sorts of things up. You can set it up for any sort of investment or savings account. Okay, so again, always about paying yourself first. It's never a bad time to invest, okay? We run into this a lot with our company, and it's really interesting, but it's not about timing the market, it's about time in the market, right? Especially for younger people, okay? You should not be worried about, you know, our market's overheated right now, is the stock market overpriced, you know, is there going to be a market correction in the next year? Are we going to have a recession in 2025? Like, should I be investing right now or should I wait for the market to pull back? You should not be thinking about those things at all. The only thought you should have is, how much can I afford to save for my future today? And put that into your investment or savings account. If it's in your investment account, get it invested. Don't try to worry yourself with whether you're getting in at a good time or not. At your age, there is no bad time to get into the market, okay? So you shouldn't be thinking that way, okay? Don't buy the hype. Fear sells, okay? Especially at your age, try to ignore the headlines as much as you can. Again, time is your most valuable asset when it comes to investing. There's nothing more important than time, okay? So ignore the headlines. Now, 30 years from now, maybe that might be a little different story. You might want to be a little more defensive and a little more thoughtful. But at your age, okay, you should not be worried about headlines, okay? If global financial markets melt down, the US dollar becomes worthless, the stock market implodes, guess what? It's not going to matter whether you had your money invested, okay? Because we're all going to be in really, really bad shape, right? So that's the way I look at it. If there exists a world where, you know, everything burns to ashes, okay, you're not going to regret having invested money in the stock market. I guess maybe you might have wished that you would have bought a bunker somewhere and a bunch of, you know, processed food that's going to last for 30 years, but that's a different story, okay? Just don't worry about the headlines, okay? And do your best to try to also ignore all those financial gurus on the internet, or the financial gurus living in your dorm room, or the financial gurus living down the street from you, or your friends, your parents' friends who are financial gurus. Try to ignore all of these people unless they actually are finance professionals. Even then, you might want to be a little skeptical and don't just completely buy what they're selling you. But ignore the noise. This doesn't have to, especially at your age, this doesn't have to be difficult, okay? Save your money, invest, we're gonna talk later, in an index, you know, low cost funds. It doesn't take a whole lot of effort to get it right. Now, as you get older and you make more money, and maybe you start a family or you start a business, as your financial picture gets more complicated, that's different, okay? But even then, make sure you're seeking out true professionals, okay, in the industry, not some random blog on the internet, okay? Don't fight it, embrace it, okay? The United States has gone through great efforts to make it as easy and thoughtless as possible for you to save for retirement. And the reason for that is because there's an impending retirement crisis in the United States. Okay, over the next 2 decades, we're going to have lots and lots and lots of people get to retirement age and not have the assets saved to actually retire. A lot of that has to do with the history of the retirement industry in this country that we don't need to talk about today, but the 10-second version of it is we used to have a pension or a defined benefit system where you work for the same employer for 30 years, you retire, and they pay you a guaranteed paycheck, or quote-unquote guaranteed paycheck every year. What that basically meant was you didn't necessarily have to save for your own retirement. Between Social Security and your employer saving for you, you were pretty much taken care of. That all changed because that obviously creates a huge liability for those companies. They wanted to get out from that liability. So now they put the onus of saving for retirement on you, on the individual, okay? And as we know, investing is inherently making a sacrifice, right? I can take this $100 today, go have a good time this weekend with friends, or I can save this money and spend it 30 years from now, right? Most people want to spend that $100 today, right? So every dollar you invest is a dollar that you're sacrificing today, okay? And that's very hard for a lot of people to do. Therefore, we have chronic under savings in the United States, okay? So the United States has done a lot with regulations. Secure Act 1.0, now we've had the Secure Act 2.0. 401k automatic enrollment, so now employers can automatically enroll their employees into retirement savings plans. The new thing for Secure Act 2.0, automatic escalation. So you might start off at a 3% contribution, so basically 3% of your paycheck going into your retirement account, okay? Employers can start you at a minimum of 3% and have that increase by 1% per year up to as much as 10%. Don't fight those things, okay? We're putting those in place to help you save and to save more and to save and save more early. Those things are good. You have the option of opting out of those things. Don't opt out, don't fight it, embrace it, okay? And at a bare minimum, you want to try to maximize the contribution your employer will make to the plan. All right, so just visually real quick, the benefit of saving and investing early, okay? So this blue line here is if you consistently, we have $200 invested monthly, and you consistently invest $200 a month every month from the age of 25 to 65, and you earn on average 7% per year on those investments, right? So we're not even assuming that as your income grows, your savings will grow. It's just a flat $200 per month from 25 to 65. You'll have $512,000 at age 65, right? Probably not enough, probably not as much as you would want to have. That's why as you progress through your career and make more and more money, you should be saving more and more. But what I really want to point out here is over that period, well, it's not going to work, all right, that's fine. Over that period of time, okay, the amount of money that you put into the account was $96,000. But the value of your portfolio at 65 is almost $513,000. So what that hopefully tells you is at retirement, a majority of your wealth was actually made up of the returns you made on your investment, not the investment itself, right? Now, how about somebody, same exact situation, but now instead of starting at 25, you start at 35, right? You delay it by 10 years. You've got $242,000. You got less than half of what you would have had if you started at 25. So that 10 years makes a massive difference, okay? So it really emphasizes the importance of starting early. Okay? And then the other thing is taking appropriate risk with your investments. Okay? So the green line is if you had started saving at age 25, but you invested your money in very safe, say, savings account or money market funds. So you saved the same amount, $96,000, but you didn't even double your money over the course of the time because you took so little risk with the financial assets that you invested in. Okay? So that's another very important point to make. Remember I said the most valuable asset you have when it comes to investing is time. Okay? The more time you have, the more risk you can afford to take with your investments. Okay? Now, when I say more risk, I'm not talking about highly speculative investments, investing in companies that are, developing technology for batteries that, may or may not be profitable at some point in the future, right? So there's a lot of companies out there that are highly risky, but they're more speculative than they are risky. When I say risky, I just mean don't be afraid of investing in stocks, which are riskier than, say, money market funds, which are very low risk, right? Give me 1 second here. PowerPoint decided to crash on me. Any questions on anything? I'm going to start moving a little quicker here. So this is a really neat slide that just kind of, again, hammers home the importance of saving early, and more importantly, how important your investment returns are to your wealth in the future. Okay? So early on, so again, starting at age 25, early on, the majority of your wealth, 94%, is made up of your contributions, how much you actually invested out of pocket. But when you fast forward to age 65, 70% of your wealth is made up of the returns on those contributions. Right? So again, contributions early on, hugely important to your wealth in the future. Benefits of automatic escalation. So if you start at age 25 with a consistent 10% contribution, and there's some assumptions about income and whatnot, but you start off with 10% contribution at age 65, you've got about $2.2 million. Okay? If you start at 3% and leave it at 3%, you have far less money because obviously you're saving less. But if you start at that 3% and let it auto escalate to 10%, what you see is the gap isn't massive between those two scenarios. So again, that's what the government's looking at when they decided to adopt these rules where employers can automatically opt employees into this automatic escalation. Okay? For a lot of employees, they set their contribution to the retirement plan and then they never think about it again. Right? So that automatic escalation can make a huge difference for your financial future. Okay? All right, some other thoughts. A globally diversified approach. Okay? So from January of 1970 to December of 2023, we have a globally diversified equity portfolio. So $1, might not be able to read that very easily, $1 invested in 1970 would have grown to $733 over this period in a globally diversified portfolio. That same dollar invested in only the S&P 500 index, so only invested in the US, would have grown to $242. Right? So especially recently, US markets have far outpaced international markets, okay? But this is really pretty typical. If we look through time, we go through waves of outperformance in US markets versus international markets. Now, no doubt, the period of time where we just went through 14 years worth of US outperformance, that's pretty significant. But if you look over the longer view, you see that there are waves. And if all you invest in is US securities, then you're only getting the US waves, right? So a globally diversified, the idea of a diversified approach is that you're getting exposure to all of that outperformance. Not 100% of it, but at least you're getting exposure. Okay, as long as I have exposure to both US and internationals, then I'm benefiting from all of these waves instead of just some of these waves, right? That's the idea of diversification. And this just hammers it home a little more. We've got US large cap companies, value, okay? So these are US companies, international companies, emerging market, fixed income, okay? And that's just basically ranking from top to bottom, the best performers in any given year to the bottom performers. And what you see is there's no pattern in here, right? So again, the power of diversification is eliminate trying to figure out where to be invested when. Just invest across the entire spectrum, and then you're going to benefit on average in the long run. Okay? Remember, don't buy the hype. Fear sells. Okay? The sky is not falling, I promise. Okay? Here is the market response to different crises. Okay, so performance of a balanced strategy. So this is actually a relatively low risk strategy, 60% stocks, 40% bonds. Okay, you've got the 1 year market performance, 3 year, 5 year. Okay, and you've got 1, 2, 3, 4, 5, 6, 7 major crises. Okay, it doesn't include the pandemic on this slide. But what do we see? Okay, typically it only takes about 3 years to be more than back from any crisis. And typically it takes far less than that. Okay? In the moment, it might seem very scary. 2022, okay, given your age, you might not appreciate necessarily how bad 2022 was, but it was a very, very bad year for investing. People have already forgotten about it because 2023 and 2024 have been really, really good. And we're setting new market highs, right? So, especially when you're younger, right? Remember, time is your most valuable asset. You should not be fearful of crises. You should not be fearful of pullbacks. These are opportunities. Instead of pulling investments out of the market, you should be trying to find every dollar you can spare to invest into the market. Okay? So don't be, especially when you're younger, there's no reason to fear financial markets when things are not going well. If anything, there are opportunities. Okay? This gets at that point at a more micro level. Okay? So the gray line is telling you, or the gray bars are telling you what the total return was for the entire year. And these red dots are telling you what the largest market pullback was during the year. So from a market high to a market trough during the course of the year. Now what we see is, and this is why as long-term investors we want to stay invested in markets, what we see is the annual return in the market is positive far more often than it's negative. But in every single year, we have decent temporary pullbacks in the market. And actually, if you look at the average, of the pullback over the past 40 years plus, it's 14%. So having a 14% pullback in the market in any given year is perfectly normal, right? But when we're in the midst of those pullbacks, the headlines will make it seem like, again, the sky is falling. When in reality, these pullbacks are perfectly normal, right? So, just to hammer it home a little further, just get in, jump in, right? Invest. Again, people get real scared about investing at a market high, right? So we're dealing with this right now with some clients, right? They've got some money to invest. They're afraid they're investing at a market high right now, which they are, right? We just set a new market high last week, right? But let's look at the average annualized returns after the S&P sets a new market high. Look, 1 year, average 14% return. So even after a market high, guess what? The market tends to go higher. After 3 years, it's almost 11% per year. After 5 years, 10% per year. How about after a market decline of at least 10%? Very similar numbers. Guess what? The long run average return on the S&P 500 is 10%. That's why over a 5-year period, whether we're at a new market high or not, the average return is about 10%. After a new market low, 10%. In the long run, we're going to have those positive returns. That's why we invest. But it's important to stay invested. Okay? And this is all you got to see, right? This chart is showing all the bad things that have happened from 1970 to the pandemic. And through all of that, $1 would have turned into 100. Okay? This is why we invest. Look at the long run trend. It's up. And again, about 9 to 10% per year. So you want to try to avoid the short-term noise and focus on the long run trend line. All right, last thing I want to leave you with, fees matter, and they matter more than you probably think. Okay? So what this is just showing is the impact of an extra 50 basis points in fees versus an extra 100 basis points. So in other words, a 0.5% versus 1%. Okay? And what we see is from age 25 to age 65, okay, reducing your average annual fee, all else equal, by 50 basis points can save you a ton of money. Reducing that by 100 basis points can save you even more. And another way of looking at this is how much more income do we have in retirement by keeping our fees low. 50 basis points buys you another 5 years, 100 basis points buys you another 13 years. So everybody likes to talk about the power of compound return, which I've highlighted a lot here tonight, but fees compound as well. Every extra dollar you pay in fees is a dollar that's not earning you money for the next 40 years. So that brings me to this idea, our last idea of index funds versus active, okay? And I want to make sure that we kind of understand the important distinction between passively managed index funds versus active funds. Okay? Passively managed funds, also known as index funds, simply invest in some predefined list of stocks. So the S&P 500, right? Standard & Poor's Global is a company. Part of their business is to manage a bunch of investing indexes, one of which is the S&P 500. S&P Global is the one that determines which companies make up the S&P 500. So if I'm the fund manager of an index fund that's just trying to mimic the S&P 500, my job is very simple. Someone's done it for me. Here are the companies I need to invest in. And this is how much to invest in each one, right? So because my job is very simple, I'm just replicating some index. the fees that I charge for that service are going to be quite low, right? Now, for an actively managed fund, it's quite different, right? An active fund is trying to provide better than average performance, right? So if I'm a fund manager and I just invest in all 500 companies in the S&P 500, the return on my index is just going to be the average return of those 500 companies, calculated, okay? But if I'm an active fund manager and I'm investing in large cap US companies, I'm not investing in all 500 companies because I don't want to generate an average return. I'm trying to generate an above average return for my investors, right? So I'm going to be trying to actively invest in only the companies that I think are going to perform well in the future, and I'm going to try to underweight or not invest at all in the companies that I think are going to underperform, right? So the index gives me an average return. Active management is trying to give me an above average return. Well, because a lot more resources are required to perform active management, the fees are also higher. And because the fees are higher, actively managed funds have a hard time providing that above average performance. In other words, actively managed funds have a really hard time outperforming index funds, low cost index funds, okay? So this is just some academic findings to suggest that, okay? This is actively managed mutual funds from 2002 to 2021, okay? In 2002, starting with 2,813 funds, only 44% of those funds survived that 20-year period. And only 18% of those funds were considered winners. In other words, had an average return greater than the benchmark, right? So, active management is good in theory, and if you can identify truly talented management teams that are capable of providing consistent outperformance, that's great, but it's really hard identifying those managers. I can tell you that from experience, okay? So if the professionals can't do it, what makes you think you can, okay? Or for that matter, your friend or your neighbor or et cetera, right? And there's all kinds of evidence to suggest that professionals with teams of people and, you know, almost limitless resources have a really, really hard time outsmarting the market, right? So what's the point? There's no need to do it. And more than likely, if you try to do it, you're only going to hurt yourself in the long run, right? So I would implore all of you, again, unless you have a family member who is a professional that you trust, or you're very much into this and talented, and you have a lot of time to invest in, you know, doing active management on your own, okay, your best bet, you know, 99% or more of all people would be to just pick a handful of low-cost index funds, create a globally diversified portfolio, and just throw your money into that portfolio and don't think twice about it. Okay? It'll eliminate a lot of stress, okay? And you can just block out all the noise. All these people that worry about what's going on in the markets, people trying to give you hot tips on what the next NVIDIA is going to be, you can just ignore it all. You don't have to worry about it, right? You just throw your money into your portfolio and let it work for the next 30, 40, 50 years, right? All right, and then the one last thing, 7 o'clock. So a 401k plan, like we had talked about, your retirement plan through an employer, when that money comes out of your paycheck and goes into your retirement plan, it's coming out pre-tax, okay? So that's good for you. It reduces your taxable income, right? So if you contribute $5,000 into your 401k plan, that $5,000 goes in before Uncle Sam takes taxes out of your paycheck, okay? Now the catch is when you retire at some point in the future and you start taking money out of your retirement plan, then you owe income taxes at that time. But the idea is when you're in retirement, your income will be lower, therefore your tax rate will be lower, so you'll be better off, okay? Now, that may or may not be the case though, because I work with a lot of clients who are in retirement who take lots of income off of their investments, right? So it's not like they're in a $100,000 tax bracket. They're still in a high tax bracket, right? So it still might be the case in the future that you might want to think long-term strategically about the tax consequences of your investments today. With a Roth IRA, your contributions are going into the account after tax, right? So you're paying Uncle Sam taxes first, and then your money is going into the account. But the catch is, you'll never pay taxes on that money ever again. The investment income that you earn and the contributions you made, that entire account, unless we get the rug pulled out from under us in the future, which we would be grandfathered in that case, but you'll never pay taxes on it again, right? So for young professionals, right, just getting started in saving, when your income is relatively low and your taxes are relatively low, that's the other thing. We're in the lowest tax rate environment pretty much in decades right now. That's probably going to change pretty soon. But in general, early on in your career, when you're not a high earner yet, it might make a lot of sense to put those contributions into a Roth account, right? You pay relatively low taxes on it today, and then you'll never pay taxes on it again. So these are the sorts of things that you need to start thinking about. Now, this is something that you might want to consider. Your parents might want to hit me over the head for this. But for any of you who are making income right now, you're working and making income. Okay? So long as you're making income, you can contribute to a Roth or traditional IRA. Right? Now, you may not be able to afford to contribute too much because you're obviously working for a reason. You're probably working because you need that to supplement your income to, pay tuition or room and board, those things. But there's nothing stopping your parents or grandparents from making a contribution in their Roth account for you, right? So I actually have several clients that are doing this. They have kids or grandchildren who are in college or even in high school. And they got a job and they're making money. And that allows the parent or grandparent to make contributions to a Roth account for their child or grandchild. And that's money that their child or grandchild will never pay taxes on ever again. So it's a really, really powerful thing. Now, obviously not everybody is in a position to be able to do that, I understand. Okay, but those are the sorts of long-term type of strategies that we talk to with some of our clients. All right, I'll open that up to any comments or feedback. That's all I've got. I know I threw a lot at you. Yeah.
Can you talk about the penalties for the Roth and the traditional IRA?
Yeah, so at this point in time, there will be no penalty as long as you wait until 59 and a half to take distributions. If you take distributions prior to that point, then there's I believe 10% penalty plus you owe taxes on those disbursements from the account. So, in an ideal world, the money that you're putting into retirement accounts is money that you feel reasonably confident you'll never have to touch until that point. For any money that you want to save and invest, but that you think you might need at some point in the future, it might make more sense to just invest that in a traditional brokerage account so that you can still earn earnings, returns on that, but it's readily available there for you without penalty if you need it in a pinch. So with our clients, it's nothing novel to what we do, but it's like a bucket approach, right? You have your emergency funds, you have your intermediate savings, and and then you've got your long-term savings. And if you build those buffers, then you've got a better chance of not having to touch those long-term savings. Yeah.
What is the age you can withdraw from a traditional IRA or a 401k?
Yeah, so it's 59 and a half without penalty.
Okay.
Yeah.
Besides like retirement funds, are there other kind of funds that have like different purposes? For example, like is there like maybe like an education, like
Oh yeah.
those kind of funds?
Yeah, so 529 is, money goes in pre-tax. And as long as that is used for educational purpose for your kids, then you can use those funds for that. Those can be gifted, so like say your kids end up needing it, they can then be transferred to your grandkids. But yeah, you have health savings accounts, and you have all kinds of different accounts available to you especially once you're employed. And it's really, really important to either educate yourself or work with a professional that understands those things, because there are optimal ways of saving and there are suboptimal ways of saving. And obviously, the more optimally you save, the more you're going to have, in the future. Yeah.
So do you see the withdrawal age increasing, let's say in the next 10 years or 20 years? Because,
yeah, I mean, they're constantly adjusting
Okay.
the age at which you have to do things, and inherited IRAs, for instance. So like, say your parents were to pass away and you inherited an IRA account from them. The government, it used to be that you could wait until your retirement age to withdraw from those accounts, which just allows that income to grow even longer tax-free. Government changed that recently. Now there are special exceptions, but most people have to withdraw that money within 10 years. So that does two things. It allows the government to get their money sooner, right? And it allows them to get more of it.
Right.
Because if you're working and making money and also being forced to take distributions from the inherited IRA, you're taking those distributions while in a higher tax bracket.
Okay.
So, smart on the part of the government,
Yeah.
not so great for us.
And are there any retirement income plans, in a sense where you have these plans that pay dividends? Do they have this type?
So I'm sorry, say it again.
Like those retirement plans, for instance, a regular S&P 500 portfolio that's used as a retirement plan and it pays dividends. Does that exist or no?
Well, I mean, any income that's generated within your retirement plan is generally automatically reinvested for you. Yeah. So there will never be distributions from the account until you request the distribution to be made. But yeah, any income generated within the retirement plan is just reinvested automatically.
And for the Roth, if you request a distribution of the income, you get taxed on that or not?
Yes.
Yeah.
Or there's a penalty.
Okay.
Yeah, there's a penalty.
Interesting.
So I'm gonna ask a simple question. What low-cost index funds do you recommend us investing in?
I can't give specific advice, but what I would say, like we talked about in here, just don't be, narrowly focused on, say, I'm going to invest all my money in the S&P 500, right? Or, a really common thing that you'll read out there and that people talk about is the Vanguard Total Market Index. You don't have to decide this, that, the other. Just put it all in the Vanguard Total Market Index, and you have a well-diversified portfolio. And I would say you've got a relatively well-diversified U.S. investment portfolio, right? You do not have a well-diversified portfolio doing that. So, the other thing I would say is most people think ETFs exchange traded funds, so the index funds that you can buy through your brokerage account, like VOO would be Vanguard's S&P 500. Most people just assume ETFs are index funds, and that's not the case. Active managed funds that are ETFs are becoming very, very popular, and they come with higher fees. So you just want to make sure that you are investing in well-diversified index funds. I would look for some well-diversified US fund. I would look for a well-diversified international, emerging markets. And for younger people, you know, I would be doing all equity. Okay, I wouldn't be worrying about fixed income funds or money market funds. Or I would be investing in a well-diversified stock portfolio. Yeah.
Since you can't say like specific funds, what would be, or do you have any advice on how to go about finding good funds, or like any resources that you would recommend?
Yeah, I would stick with, especially if you're, you know, relative, I guess novice, or, you know, I mean, I would stick with resources from companies you recognize, right? Like your JP Morgans of the world, your Vanguards, your Fidelities, your, you know, Merrill Lynch, those companies. And, you know, at your age, robo-investing is not a terrible thing. A lot of those companies provide the types of investment models I'm talking about for you at a very low cost. So your money goes in, and then they automatically diversify that money across a handful of their own index funds. But it usually comes at a relatively low cost, and you know, that's not a bad way to go either.
Is that right?
No. All right, I got a 6-year-old to get home too, so.
All right, I want to say thank you all for coming. Next week, we're going to be doing